We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelming on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Bob Coleman from Idaho Armored Vaults. How are you today, Bob?
Good. How you doing?
Great to have you back. So the last time you and I spoke was about 5 months ago, and at the time you were explaining that the Comex was actually getting stronger, and now we're in a bit of a different situation. So can you explain to us how this is changing right now?
Yeah, during our last interview, we talked about how a lot of metal was coming onto the Comex, and mainly that was due to the arbitrage premium that a lot of users of metal or producers of metal were taking advantage of. That premium, basically the paper premium that they could take their physical product with. Instead of selling that into the market, they were actually depositing it on the Comex and maybe selling a futures contract against that and then rolling that contract and collecting that extra premium. Well, now that the arbitrage premium has basically vanished, meaning the physical price has come up, close to, say, for instance, the futures price, it makes more sense now to start taking that metal off the market, especially when you could sell that physical bar at a premium, to a refiner or a mint or a user. So it's paying the bar holder more money to actually now go ahead and sell that metal. And then, of course, now you also have the other end of the spectrum, producers or refiners that had taken metal, put it onto the exchange last year, because, for instance, production issues, with COVID and so forth, they couldn't make as many products. So instead of leaving the bars on their shelf in their own warehouse, they may have put it onto the Comex and started to make money, on a monthly basis or every couple of months by rolling contracts. Well, again, now that there's greater demand for physical product, and of course the arbitrage premiums have went away, you're seeing those bars leave the Comex, and in fact, some of the refiners don't want to give up that product. They actually want the product back so they can actually make product or smaller bars and coins and things like that for their customers.
Mm-hmm. Can you run through us really quick what the backwardation of the futures contracts means and how this fits into there as well?
Sure. Yeah, the backwardation is basically when the cash price or the spot price is more expensive than the futures price. So in that regard, that basically is a telltale sign that the arbitrage premium that usually you can try to gain when, for instance, the spot price is at, say, for instance, gold at $1,700 and the futures price is at $1,715, you can sell the $1,715 price in the future and gain that extra premium. Well, now that the premiums are fairly non-existent, there is no motivation or incentive to keep that metal on the exchange. So the spot price basically is now much more expensive than that futures price.
Mm-hmm. So obviously we know that March was delivery month for the Comex. So why don't we start by kind of running through some of the terms that the Comex uses, such as allocated, unallocated, open interest, registered, eligible, things like that, just so that we can give the audience, maybe a refresher on what these terms mean.
Sure, definitely. Well, just to kind of separate London from New York, allocated and unallocated are the terms for London storage. And basically, in those two terms, allocated metal is metal that's designated with bar numbers and for a specific account, and that's metal put aside for an account. Unallocated positions are basically, it's a general liability type of an account where there's maybe not necessarily specific bar numbers associated with that, but it may be someone's balance sheet that actually backs that unallocated account, if that makes sense. And so in New York, you have what they call eligible and registered categories. The registered category is metal that's on the exchange that actually has warrants attached to it. And so that basically is metal that backs the futures contracts. And then you have the eligible category, which is basically just bars that meet the Comex requirements for good delivery, but it's metal that's held in private hands. So it could be put on the exchange, but it doesn't have to be. So if it's a 1,000-ounce bar and it meets the hallmark requirement and the fineness and so forth, it can be put on the exchange if it wanted to. But in most instances, the eligible category is more for longer-term holders. They just happen to be storing metal at a Comex-approved custodian, but it doesn't necessarily mean that it's attached to the Comex with a warrant.
Okay. And how about open interest, Bob?
Open interest is just the outstanding futures contracts that are currently active. And so it's a way to kind of gauge how much demand there could be for a specific futures contract. And then, of course, you have the daily volumes that occur each day that will add or subtract from that open interest.
Mm-hmm. So, of course, when we're looking at, the silver squeeze and everything that has happened with it, do you know how much silver has actually been delivered out of the Comex this month? And, what that capacity really is, and if they were really ever in danger of not being able to deliver for those contracts?
Yeah, there's a lot of puffery, I guess, that goes on in the physical world. A lot of people talk about the delivery reports that are put out. Maybe we could start there and get people a little bit more clarification. The delivery report, the Comex does two things, or the CME group does two things. They have a delivery report, and then they also have the stock reports, which is the warehouse and stock reports. Basically, it tells how much actual metal is at each individual facility. The delivery reports, all that report does is just tell you how many warrants are changing hands. It has absolutely nothing to do with moving physical metal out of the facility or out of one facility to another facility or from one client to another. It's just simply warrants that are trading hands where the bars are staying relatively stable or at the same location. Mm-hmm. The warehouse stock report, which is what I follow, that gives you really the movement of actual physical metal. And it takes a lot of the noise out of the equation. That actually has seen quite a bit of movement of metal coming off the exchange, meaning I think about 2 weeks ago it was about 150 million ounces roughly in the registered category, which is the category that the metal backs the futures contracts with. Well, you've had, I think as of today, you're down to about 127.8 million ounces in the registered category for silver. So you've had about 23 million, 22 million plus ounces that have left the Comex registered category. Now, some of that has gone to the eligible category to maybe just be a long-term investor or someone that's just storing the metal, they don't want to get rid of it. But you've also had a net, 12 million or so ounces actually completely leave the Comex approved custodian's vaults. So that's metal that has just left the building, so to speak. And it may have gone to refiners, it may have gone to mints to aid in production of smaller coins and bars, that type of thing.
Mm-hmm. So have you been able to see any shortness in this 1,000-ounce bar market that, for example, the Comex uses to back these futures contracts?
On the Comex itself, there's plenty of metal out there. Mm-hmm. And that's why you're seeing the millions of ounces leave the Comex because people are demanding the product and that product is flowing. You may have tightness in the 1,000-ounce bar market in other areas. For instance, some refiners trying to get bars over the counter or maybe principal transactions to other parties. Maybe you have delays of getting delivery of those bars. But it doesn't mean that the bars aren't completely unavailable. It just means that it's just taken a little bit longer to get delivery. And of course, you have, in some instances, if you're looking at silver shot, for example, that's like the little BB type of silver product that some refiners will use to melt that down instead of 1,000-ounce bars. That's in high demand. That may be difficult to get as well. So depending on the type of product that refiners use to then maybe make smaller bars and coins and that type of thing, or 1-ounce rounds, that may dictate the demand for 1,000-ounce bars. It may dictate the need for the speed of demand or speed of delivery of those bars.
Mm-hmm. So when you and I were speaking before, you said that there's a big difference between tightness and shortness in the market. So can you define both of those and give us a real sense of where that 1,000-ounce bar market really is right now?
Yeah, what I kind of try to define or distinguish between two is tightness is basically where you just simply have delivery delays, where it may be a production issue, it may be a logistics issue, but the original product or the origin of the product is still coming to market. So it's just a delay in time. Mm-hmm. Whereas the shortages are more of, hey, listen, the mines are running out. You have severe delays in product availability. Like, for instance, back in 2008, where it took 4 months to get delivery of anything silver refined, that was a shortage. That was very extreme. Imagine putting your money down and waiting 4 months to take delivery. That's a real shortage. Right now, you're probably 2 to 3 weeks out, maybe 4 weeks out of getting delivery of most products. So it's more of a production issue. You see a lot of it with the COVID situation where staff is being minimalized and maybe shifts are being increased to avoid a complete shutdown of a facility. And so things just aren't operating at full capacity. And that's having an impact, especially on the smaller coin and bar market.
Mm-hmm. So recently when I spoke with David Jensen, he pointed out that the London silver lease rates have recently spiked. So how do you explain this spike, Bob? And does this just show increase in demand right now?
Yeah, it was an interesting thing that he pointed out, and I appreciated when he posted that chart, because that kind of explained a lot to me what was happening in the market at the time. You had that big demand going into ETFs, especially with SLV. SLV has a requirement where typically they need to have allocated metal in the account and reported, I think, by 9 a.m. the next morning. So I think that put stress on the authorized participants to actually go out into the market and have metal that was probably already on receipt at a depository, but it was metal that was probably leased by the authorized participants to deliver to SLV. And the reason why I say that is if you look at the construct of how metal went into SLV during that busy week, they actually created a new depository account with Loomis, I believe, and it deposited 30 some odd million ounces into that depository. Well, you can't just move 30 million ounces overnight. That would be a huge undertaking. And then also to have a complete bar list of all the bar numbers, serial numbers, weights, fineness requirements, and that type of thing, to have that completely ready and prepped, the metal already had to be there. So for that to happen, if you look at what happened within a week later, when shares started to come back out of the SLV, the depository that basically a lot of the metal came back out of first was the metal that came in last. And so that kind of told me that there was maybe metal that was earmarked that was brought in, and that was probably metal that was going to be earmarked to be brought out first. And that kind of tends to lead me to believe that the metal was probably leased to be brought in there.
Mm-hmm. So you recently tweeted something here, and it said, here's an interesting concept. If one had a strategy where one could lease silver while having enough capital to influence the short-term price action, why couldn't one lease the bars and deliver them to the SLV at a higher price, then use their capital to short the market, knowing that many holders in SLV are short-term traders motivated by price action? If one can shake these weak hands from SLV causing redemptions in the trust, one can redeem the shares at a lower price, take delivery of the metal, and return it to the lessor for a quick profit. Could these strategies have been used recently or in the past as part of the court cases surrounding the silver manipulation, Bob?
Well, that was the question that I raised, because to me, a lot of the stuff that goes on is over-the-counter types of transactions. Unlike the Comex, which is a regulated market and regulated activities, especially when you deal with futures contracts, there's more eyeballs watching you. Whereas in these over-the-counter types of transactions, it's more of a principal type of trade. I mean, those would probably be legal trades to do. Certainly, it doesn't stop someone from moving capital around, that's for sure. But it just provides a sense that you potentially could have some, I don't say abuse of the system would be a strong word, but someone could take advantage of the structure. Mm-hmm. And they could do it in a way that says, hey, listen, I was just trying to make a little money here, or I saw an opportunity. I thought the metals were, too richly priced, and so therefore I went into the market and I took advantage of that. I mean, there are multiple ways to look at it, but that's the kind of stuff that I look at that potentially provides an opportunity for someone.
Mm-hmm. So this kind of plays into Jeff Currie's interview on CNBC about the ETFs shorting silver. Can you explain to us, what he said from your standpoint?
Yeah, I think a lot of people misinterpreted what he probably meant to say. I think the way he said it was wrong. It didn't make any sense whatsoever because it didn't match with what the prospectus said, and it certainly didn't match. It would be breaking CFTC rules as well as the SEC if the ETFs were actually shorting their own positions. That makes very little sense, because to do that, the ETFs, or say, for instance, whatever the silver ETF at the time maybe we were talking about, but in order to do that, the silver ETF, whatever one that may be, would have to be registered as a commodity trading pool. And it's in the prospectus that these ETFs aren't commodity trading pools. They don't buy and sell futures contracts. What happens is the authorized participant is actually the one that's sort of the gatekeeper. They're the ones that are delivering metal to the ETF, and they're the ones that are providing the liquidity when the ETF needs to actually sell metal and redeem shares and so forth, and then the shareholder gets their cash back, so to speak. And so in that regard, the authorized participant would be the one that actually could be holding metal aside, waiting for instance, the SLV to say, hey, we need some metal, please deliver this to us. The authorized participant could be long the physical metal, but in order for him to protect his position, because he's not a speculator per se, he's just more of a intermediary, he may be short the paper price against his long physical position, therefore neutralizing his price risk, meaning if the price goes up, his physical position goes up, but yet his paper price goes down, and just vice versa. So therefore, he doesn't take the risk of losing money on just simply holding metal long, for example. Mm-hmm. And that's where I think the authorized participants, that's one of their roles that they provide, or they actually do, is they're the ones who are actually shorting metal that they may actually have in their own account that may be earmarked for ETFs, but it's not the ETF itself that's actually shorting futures contracts.
Mm-hmm. So as we're speaking about ETFs, Bob, why can it be a bad thing that at times that they trade at a discount to net asset value?
It could be a multitude of different things. One, it could be that position or ETF has lost favor with the market. Typically, you see when markets are going straight up, people are willing to pay whatever price to get into that asset class, to participate in the price action. If the price is going down, you may see people wanting to let go of that asset at any price because they just don't want to lose any more money. So therefore, they may sell it below the net asset value. And that's one reason. You could also have potential issues where you have, for instance, the asset structure may not be in line with how many shares outstanding there actually is. So they may have too many shares outstanding versus the actual net asset position that's actually in the fund. So you could have some type of offset there as well.
Mm-hmm. So there was another thing that you recently brought up and wrote a great thread on Twitter, and it was all about the LBMA vault custodian concerns and who is responsible for auditing their vault content. So can you walk us through this a bit, Bob, and what you found there?
Yeah, it's kind of interesting because in the United States, when you deal with the Comex, it's a regulated entity and you have multiple parties that are involved there, and you have sort of checks and balances in that system. So there are requirements of the Comex custodians there that hold the metal that they actually have to have independent third-party audits of the positions that are held in the registered category. So there has to be some oversight to make sure the metal's there. And that helps the clearing firms understand that, okay, they can trust the third-party auditors' inspection and so forth. So therefore, they can write contracts or use that metal as collateral as they see fit. In London, it's interesting because in that realm, the way I read it is that the vault itself isn't necessarily required to have their facility audited by a third party, not by LBMA and London rules. It's actually the customer that's actually responsible for that, which is a little bit different than here in the U.S. Not to say that, if a silver ETF, for instance, has metal in a depository over in London, they'll be the ones that actually have to hire a auditor to come in to make sure that their metals are actually fully there. It's not the role of the custodian itself. And so where it gets interesting is just simply the idea of, from a vault standpoint, who's actually checking to make sure that all these accounts are sort of in sync with the total numbers held at the vault. I mean, it may be one reason why it's somewhat difficult to get pure numbers of actual ounces being held in London because the vaults aren't really required to disclose all that information, unlike the Comex.
Mm-hmm. So as you and I were speaking before we hit record here, Bob, you had some, let's say, ideas on differences between your average person holding physical metals versus ETFs. So can you kind of run us through what some of our different concerns and thoughts would be around that?
Yeah, the physical metal is fairly straightforward. Held directly, meaning you either hold it for instance, at your house, so to speak, or you hold it in a depository or a custodian relationship where you have the direct relationship with the custodian, you've minimized your risk about as far as you can. As long as the custodian is fully insured, in case something happens to it, you're still protected there. Likewise, if you hold it at your house, maybe you feel comfortable guarding it yourself, and you may have an insurance policy that's attached to your homeowner's policy, that type of thing. You feel more comfortable there. That's the preferred method that I try to educate people on. If you're going to own metal, make sure you hold it directly, whether it's a vault or on person or within arm's length. Where it gets interesting is where you have third-party programs that maybe act as middlemen. So you have these master-sub relationships where, say, for instance, you deal with a dealer, they have a relationship at a depository, so therefore they can offer a convenient way of storing metal, but the program is really under the direction of a third party or a middleman. You don't have the direct relationship with that depository. You can't just call them up and say, hey, listen, I want delivery of my metal, because that depository is going to say, we don't know who you are because our account is with XYZ. That's a very common program as well. Where it gets interesting is the ETFs. And people ask me all the time, well, what's the difference between the ETF and just buying physical? Because ETFs, you don't have to worry about the premiums, you don't have to worry about the spreads. It's so much easier, it's much more convenient. Some of these ETFs I can take delivery from, maybe there's a structure to that as well. There's a lot of conveniences with ETFs. What most investors do not understand is when you hold an ETF in a brokerage account, technically speaking, you don't own it. It's not even owned by your brokerage firm. Most of the shares are owned by, like, for instance, if you look at some of these ETFs, they're owned by the Depository Trust and Clearing Corporation, or even a subsidiary of them, which is Seed and Company. They're the ones that control these shares. And I'm probably going to do a thread on this to try to explain it a little bit better, because I may end up losing people here. But in reality, if your brokerage company went under, let's just say like the Robinhood situation with GameStop, Robinhood had a $3 billion capital call that they had to meet. Otherwise, they were looking at complete liquidation of their entire brokerage account to basically come up with the collateral to provide to the clearing firm or the clearing firms that they were doing business with. That's a true risk that many investors aren't aware of. So they may buy an ETF, and it may be a popular ETF that they feel very comfortable with because, hey, maybe one day they could take delivery of it. But they may not understand that if you're buying metals for systemic risk or counterparty risk situations, and actually that does come to fruition, you could end up losing your entire investment just because the brokerage firm goes under. And that's something that most people don't understand. And that's where the physical metal then, to me, makes the most sense. Even though there may be a premium attached to the physical metal, or there may be a little bit wider spreads than, say, for instance, ETFs, you're securing your investment far more. You're removing so many more risks to the equation that if we're all worried about, debt deleveraging, systemic failure, or whatever it may be, at least I've been able to recognize that risk and try to diversify away from it using physical metal held directly.
Mm-hmm. So as we've seen in the last year, Bob, premiums have moved up on physical products a lot, and especially in the last month and a half. So can you explain to us why these premiums move up at times like this? And could it be that the bullion dealers are just getting greedy because of demand being so high right now?
Well, yeah, there's a few things that are going on. You have a lot of tightness in the market. So when there's tightness in the market, it's like, I hate to say this, but it's like the guy selling ice cubes after a hurricane. I mean, you have the situation where people could take advantage of others. And what I hate to see in this business, everyone can make money. It's a free market. I'm totally for it. And this is why people are in business, to sell metals. And they're doing a wonderful service by providing metals to individuals that want to invest in metals. The part that I have issues with is when premiums are so high that I think investors could be being taken advantage of. And that's why I've been very vocal on Twitter, trying to say to people, hey, listen, right now I think you see a lot of clients that tell me, hey, listen, or customers that say, listen, I'm seeing, silver products at $6 over spot. Yet you're selling the same product at $3.30 over spot. Why is there such a big difference between the two? And I ask the same questions. I don't understand why the products are so much more expensive when in most cases it's going to be 2 to 3 weeks to get delivery of your product anyway. There shouldn't be that much more markup, especially amongst a lot of these big dealers out there, than what needs to be. I mean, it doesn't attract the investor to the asset class if they don't see any value, or they see it's going to take an extra $6 move in silver just for me to break even. And that's where I try to provide a little bit more insight into the industry to help people recognize, hey, listen, it may be best to shop around, ask questions, try to find, the best deal possible, but do what you need to do for your best interest, maybe not the interest of others. And it's unfortunate that premiums are as high as they are. In some instances, some products I'm not even looking at right now because, like for instance, Eagles, Silver Eagles, which are a great product, normally a go-to product, they're just too expensive. There's just not enough out there, and what is out there is being bid up. And so I'm constantly looking for lower product prices or products that are available at lower premiums and trying to get the best product for the client so they can get exposure to actual physical silver without paying an arm and a leg.
So are you saying that the Silver Eagles are just too expensive even from your wholesale suppliers because they're charging that premium as well?
Yeah, and part of the reason is the wholesalers may be charging a higher premium because they have to worry about, you have to understand, the Eagles are a very popular product. It's probably the most popular product in North America. The issue that they run into is they cannot control the production of the U.S. Mint. So if the U.S. Mint happens to make less Eagles the next week or the next 2 weeks or the next 4 weeks, yet the wholesaler is taking in orders every single day, the wholesaler may not want to be what they call net short the market, meaning they've sold more Eagles than they actually will be able to get. So a lot of times they'll try to raise premiums to dissuade people into that product and maybe into other products. They may be getting the Eagles from the mint itself. The price may not have gone up at the mint's level or may have gone up slightly. But the issue is they don't want to be selling product that they may not be able to get. And so a lot of times you see, not only will they raise offer prices, they may raise bid prices as well to attract people to sell product back to them. So then they can create a two-way market, or maybe that brings more metal back into the market and that tends to lower premiums back down a little bit. But right now, there's just no net selling of secondary product back into the market. It's just constantly new buying coming in, and that new buying is basically sopping up whatever new production is being made. So you do have that tightness in the market. But there's a big distinction that between high premiums and grossly marked up premiums. That's where I try to counsel people and educate them on saying, hey, listen, this may not be the right product at the time, but take a look at this product because it's so much cheaper. Like, for instance, 100-ounce silver bars at $3.30 over spot when everybody else in the country looks like they're at $5 to $6 over spot, maybe even higher. I want the client to have the best experience possible, and part of that is to provide a product at the right price.
Mm-hmm. So, again, before you and I were hitting record here, Bob, I had asked you how you would provide the, let's say, liquidity necessary when we get higher silver prices and people are requesting a lot of buybacks on their metals. So how do you go about thinking about this and basically being able to provide a market for people that want to sell their silver and or gold back to you?
Yeah, and that's a great question because that's something that I've looked at. I kind of call it the exit strategy. And I don't think a lot of people that accumulate over time, they don't really think about the end game, so to speak, in terms of the exit strategy. They're more concerned about accumulation and just making sure that they have, proper diversification and a proper weighting in their portfolio. But it's something that's one of the reasons why I created, our depository, which is one of the largest private depositories out there. We not only, we can store it, but we also have logistics infrastructure. We have shippers policies and transit policies, so we can actually move metal from point A to point B if we need to deliver to a wholesaler or a refiner. So if it's a larger size quantity of metal that we're trying to move, we can handle that transaction in a very efficient manner, and so the client can actually have a very timely settlement of their trade. They don't have to worry about, well, I'm storing it at my house. How am I going to move? I've accumulated 5,000 ounces of silver. Now the thing is, $100 an ounce. That's $500,000, but I can only send as much as $50,000 at a time through USPS registered mail because they can only insure up to $50,000 per package. Those are the kinds of things that we try to help clients understand when they're accumulating, because they may save money storing it at their house, but on the exit strategy side, are they equipped 5 or 10 years from now to lift all the stuff up and take it to the post office or take it to FedEx or whatever it may be to ship it out? And in many cases, if clients are buying metals through a dealer and the dealer offers the opportunity to say, hey, listen, we'll charge a fee to send you a shipping label and we'll insure the package, that's great too. That definitely will help the client out. But I think the issue you run into is, especially with larger bars like 1,000-ounce bars, when you go to sell these products, if silver really does go to the moon, so to speak, it goes over $100 an ounce, you're talking a lot of value per package that you're going to have some type of insurance policy to cover. And for instance, we just raised our insurance limits on our shipping policy to $100,000 per package.
Excellent. Well, there's a lot of food for thought there, Bob, and I appreciate you coming back on to try and, let's say, clear up some confusion and show us things from your point of view. We can find more from you at Profits Plus ID. Where else can our listeners find you, Bob?
We have a website, which is goldsilvervault.com, just all one word, or they could give us a call as well. Our phone number is on our website as well.
Excellent. Do you have any final thoughts as we wrap up here, Bob?
That should do it for right now. And just, keep an eye out for us on Twitter. We'll tend to try and put as much educational information out there as possible to help people understand the markets, the industry a little bit better, try to decipher between speculation and what's actually happening in the marketplace. That way it gives people a better feel for understanding the environment, that type of thing.
Excellent. Well, thanks very much for your time and your perspective today, Bob.
Sure, my pleasure. Thank you.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.